as Ryan said, this is
No.
a review of a company that I did a Your Stock, Our Take on about 9 months ago. It was back in June, July, during the summer. So the company is Exro Technologies. And at the time, what I said about the company was that it was a very interesting technology, potentially in the future selling into an interesting space. They had some targets upcoming, but really nothing financial had been achieved yet in terms of tangible financial results. So minimal revenue, really losing a lot of money. So I said it's still speculative, but it's worth keeping on maybe your radar. And if it starts hitting some of these targets, showing something, signs of profitability, revenue growth on the financial statements, you could maybe consider it at some point in time. But just to keep an eye out. I thought that was a fairly balanced perspective to take. But a lot of times when we're dealing with these companies that are pre profitability, pre revenue, and they have some type of a technology, there's a lot of really sensitive investors out there. So you can go to the our YouTube channel and take a look. But there are a lot of comments. A lot of people were not happy with my assessment of Exro, even though I thought it was very balanced. I thought it was a balanced assessment. A lot of comments, like this. What does this person say? Chap said it best. I assume I'm Chap. Is that correct? Yeah, I'm
Could be
Chap. So I
Chappy.
said it best. Exro's technology is too complicated for these guys to understand. Therefore, they
Yeah.
don't comprehend the coming revenue potential. Okay, so this is typically what we will hear from people when we're talking about high technology companies that have produced nothing financially. So a lot of times, like no revenue, definitely no profitability. So we will be dismissive of it, not from the perspective that it could one day do something, but from the perspective that it has not done anything tangible up until that point in time. And therefore, whatever technology they have has not yet been validated, right? Because management can say whatever they want. They can talk about partnerships, until money actually comes from customers to the company to buy their product or service, it doesn't really mean anything. So what we hear a lot are people just saying, well, you don't understand, right? You don't have the ability to understand the technology. To which I say, okay, that's a fair point, but that's the point that I'm making. And I flip that on other people as well. Do you really understand the technology? I agree. I'm not an expert when it comes to e-mobility technologies. So what I want to see is I want to see a validation of that technology before I go forward and just take somebody else's perspective, like the CEO or investor relations or another investor, somebody who obviously has a vested interest and may not be trying to be dishonest, but certainly has a perspective that they are incentivized to take. So the fact that the technology is complex and has potential does not necessarily mean that it's commercially viable. And of course, there's a few comments like this. Your analysis is worth what I paid for it, zero. So there's we get the sharp ones straight to the point. You don't like what we said, but we break down the reason why, right? We don't just say, oh, we don't like this company. I mean, certainly, as I said before, I think the technology is interesting, but the first thing we need to look at is financially, is that technology validated, right? So anyways, we're going to do a review, and since then things have not gone well for Exro and its investors, at least not in the stock market. So when we did our original Your Stock, Our Take on the company in summer of last year, it was trading at $2.22. It is now down about 72%, down to about $63, 63 cents, sorry, from 222 down to 63 cents. So whatever the company has been doing has not been received well by the market, right? And that was the concern that we had. A lot of times, companies that have targets that they're trying to achieve, you'll have an opportunity to actually buy in if they start achieving those targets before the stock price really starts to take off, right? You'll be able to see some tangible evidence that those targets are going to be achieved or that they're making progress towards it before the stock is, before all the opportunity to buy is gone. So why not manage risk by doing that as opposed to just taking the most optimal case scenario and assuming it's going to be true, and investing based on that. That's basically all we're saying, right? So let's take a look at the company today, Exro, about a 200 million market cap. Those shares have about doubled since we last looked at the company about 9 months ago. I'll talk about that. Also, preferred shares existing on the company, I'll talk about. But just for those who aren't familiar with it, Exro is an e-mobility technology company developing advanced power control electronics and propulsion systems for electric vehicles or EVs. Their core technology is the coil driver and adaptive traction inverter that optimizes electric motor performance. Very big event for the company in January of this year. Exro merged with another company called C Electric, an automotive and e-mobility technology company that provides a 100% electric drivetrain system technology. Okay, so why don't we just take another look at the company's financial results so you can see what we're seeing and how we would look at a company. And we're putting the technology and the future potential aside. We just want to see what has the company achieved so far. So they did put out their year-end results. Q1s aren't out yet. This is, of course, pre-merger. But the revenue growth is actually pretty good, although revenues are still relatively minimal. But 5.7 million in revenue in 2023, up from 2.1 million. Good increase in the gross profit. But if you look down at the earnings figure, this company has lost a huge amount of money. So $50 million has been burnt in terms of negative earnings over the year. So that's up in spite of, the increase in revenue, although revenues is not really a very relevant factor right now because they're still so low. But they burnt through 40 million in 2022, another 50 million in 2023. So they're losing gobs of money. If we're to look at the quarterly figures here, revenue for the fourth quarter of the year, 935,000 compared to 1.8 million. So big drop in revenue actually in the fourth quarter, although albeit an increase in the gross margin. But then when we look at the net loss, a fourth quarter net loss of 18 million or almost 19 million, up from just under 13 million in the same quarter of the previous year, right? So, certainly in terms of the financials that they have produced so far for the market, they leave a lot to be desired. Looking at the balance sheet, they have about 6.2 million in cash. They have total debt and leases of about 19 million. And they burnt through in terms of cash flow. So I would say that's negative operating cash flow plus capital expenditures was just under 52 million last year. So if you were to just take their cash reserve that they had at the end of the year relative to their cash burn, that would only give them about 1.5 months of runway. Now, things have changed since then. They did do that merger, which doesn't necessarily bring a lot of cash to the balance sheet or improve that picture, but they also announced a share financing. And the point here is that this company is still in the position where it is highly, highly dependent on share financings in order to survive, just to keep the lights on, right? And for us, that is where the speculation is, right? A business that is non-speculative at a very base level should be selling a product or service and using the revenue and ideally the profits that they generate from that, or the operating profit, to keep the business a going concern, keep the lights on, pay the employees, keep the business alive, as opposed to relying on the markets. Because, well, what's the problem with that? If whatever your timeline is for achieving significant revenue or profitability is delayed, which can happen for different reasons, economic reasons, industry reasons, maybe a certain technology advancement doesn't turn out exactly the way that you want, or a key customer just decides to delay. Now, all of a sudden, you need money just to basically survive. So you need to go to the market, you need to raise money from shareholders. But if the market is not in a healthy situation, if there's a downturn in the market, if the appetite for companies that aren't profitable is not high, you may not be able to raise that money, or you may have to raise it at a very low price, which is not a good thing for existing investors. So this is where, we really start to differentiate between speculation and a more sustainable business. Now, these numbers are really less relevant now. Again, they're not going to only have 6.2 million in cash. They are raising more shares in the market. So we'll talk a little bit, just really briefly, about this merger that they recently they recently completed. So with this merger, with this technology, what they are targeting is they're targeting the delivery of more than 1,000 propulsion technology systems to OEMs in 2024. So that's this year. That's what they're targeting, and forecasting revenue in the current year to be over 200 million, and potentially they're on the road for profitability within 12 months as of the acquisition, or as of the merger completion date. So this sounds pretty good. I mean, if they are able to achieve those targets, and that's still a big if. What have they had to do so far to complete this merger? Well, they added 146 million plus shares, common shares, to the company. So they were at about 170 million shares to do the merger. They had to add another 100 and almost 150 million. So now they're at 315 million shares. They also had to add 160 million preferred shares. So this is what you have to do in order to keep the business running and invest in your technology when you're not actually getting money from customers, is you have to massively expand that share base. Now, what does that mean? Well, maybe they do achieve that target of 200 million in revenue for the year, and maybe they do achieve profitability. But when you have, plus they're raising another 42 million. So by the time that profitability is achieved, maybe you have 500 million shares out, 600 million shares out. That's a lot of shares, especially for a company this size. That is a lot of shares. You have to generate pretty significant earnings in order to get any type of EPS off of that, right? So this is the risk. And if there's any type of delay in their timeline to achieving this profitability or achieving this level of revenue, then of course they have to go back to the market. They have to raise more. So this is the issue that we're dealing with here. Our take on Exro, we say it continues to be speculative. The targets are interesting, but again, even if they make 200 million in revenue, how much profitability are they going to be able to draw to the bottom line? We still don't know what the margin profile is going to look like. There are just a lot of unknowns. So I'm just going to say again, I mean, I don't want to bag on this company. I don't want to say that it's, not going to be ultimately successful. I don't know. I just haven't seen the tangible evidence yet that it's going to transition from being what I consider to be a very speculative company to a sustainable business. What would I look for over, say, the next year? Well, I would want to see a ramp up in commercial production. So they did start, I believe, what they refer to as commercial production in the fall. But the CEO did say that they're starting, at a very low level and ramping up very slowly. So we haven't really seen a full ramp up as far as I'm aware. At this point in time, we want to see that commercial production ramp up significantly. We want to see concrete, tangible progress towards achieving the goal of 200 million. So, I mean, if they put out a quarter with 50 million in revenue and a significant decline in operating loss, that's a really good sign. And then also indication of what the margin profile is going to look like when they actually do achieve that that level of revenue. Are they going to be able to drop much of that to the bottom line in terms of earnings, and enough whereby they can generate meaningful earnings per share? Okay, so this is just really, it continues to be a show me story from the perspective of Keystone. That's it. I'll open up the.
No, and I mean, it's a good point. It's a general point on our research to say that we are looking for companies that have already shown us. They've shown us they have good growth in revenues, good growth in earnings, and good growth in cash flow, and they're trading at reasonable valuations. And then you get the comments like, well, then you've missed out on the story. Well, we were told that right after this. When Aaron did the segment on Exro, we said we'd rather buy a company called Hammond Power at the time. We think because it has good solid revenues, good solid earnings, good solid cash flow, and traded at reasonable valuations and had those fundamentals to back up what the business is doing. And I can share my screen quickly just to show you. This is Exro over that period of time. It's down 70%. We said Hammond Power in that range. It's up over the past year about 231%. And we talked about the reasons for this. Well, it's good growth in revenue and earnings and cash flow over that time. But you can see the growth in terms of revenue up 27% over the past year, net income 41%, EBITDA is up 40% over the past year. And that's what we're looking at to drive a company over the long term, a good solid business with good solid cash flow. And I'll highlight here on Hammond Power as well. As you can see, the share count over that period, about 10 years ago, 11.7, 11.9. So basically no issuance of shares. They haven't needed or been beholden to the capital markets. And, this is a company that's performed tremendously well over the long term, business that we can understand as well. So there is kind of in a nutshell, the way we look at the markets, a company that was brought to us, Exro. We were asked to evaluate the company. We said, okay, based on our criteria, it doesn't meet our criteria because it hasn't proven out in terms of having cash flow in the business. Here's another selection that you can benefit from electrification that is that is involved with the electrification sector right now, creating cash flow and earnings. And you can see the juxtaposition in terms of Exro down 70% and Hammond Power over that same period up around 230%. That's why we look at companies with cash flow and earnings to give us better returns over the long term. All right. Any other further comments on that?
Do you know how much SEA or C, I'm not sure which it is actually adding to the revenue just off? I don't know. I couldn't find it if they announced it anywhere. Because that'd be interesting.
I have not. Now, there were some documents that they had on their merger website that may have had them. I know that as they said, the combined company, they're targeting 200 million in revenue, but that's assuming 1,000 units sold through the year. So that wouldn't, since it's a private company, I'm not sure if that.
Yeah, I couldn't find any either. I was just curious because
sometimes it's not going to be like, I mean, I could look further, but it's not going to be very meaningful, because if it was very meaningful, like there is, 50-60 million in revenue there, then that would have been included in the press release.
Yeah, that's what I was thinking as well. So it really is requiring them both to grow, which is the point I wanted to make. They aren't coming in with 100 million revenue off their acquisition, anything like that.
I don't believe so, no.
So it is really two early stage production companies merging together more than anything.
Yeah.
It's interesting. We'll watch the company over the course of the year. But again, with the share count, to have a per share cash flow measure that's going to make them look either undervalued or fairly valued, they have to have now a significant hard number on cash flow going forward, and we'll see if they can execute on that. But
it almost
again, you've already lost 75%.
Like that is then going to be, not have to do a rollback at some point in the future, right? I mean, I don't think I've ever seen it where the share structure starts to get like that before you're even close to profitability. And then everything just turns out fine.
And we would expect some kind of share consolidation.
I hope it is successful, to be honest. I mean, I think it'd be great to have a successful clean tech company like that
in the Canadian market. I mean, there's far too few of them, right?
Prove me wrong. I just haven't seen any evidence that
and that's why when we're deploying our money, when we're mainly deploying our clients' money, that's why a basic tenet to our researchers for a company to have cash flow and grow that over time. And if we don't see that, doesn't mean it's a horrible company, but it doesn't make our criteria. So saying that we're wrong based on a company not making our criteria doesn't make a lot of sense. Feel free to disagree, and we'll continue to revisit those situations over the long term.